Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to the lowest rates at the lowest cost in Arizona. And if you don't believe me, well, call me. So what causes mortgage rates to change exactly? Well, mortgage rates change daily and sometimes multiple times per day. These frequent changes are not arbitrary in any way. Instead, they are a result of multiple factors with varying levels of importance and interdependence. Mortgages exist because investors want to earn interest by offering loans. Because of this, mortgage rates end up being directly driven by all various market forces and operational considerations that dictate what those investors can, should, must charge. Much like mortgage borrowers need money to buy a home, the U.S. government needs money to finance federal spending. Political commentary aside, this creates a massive market for government debt, which in turn serves as the plainest, most risk-free benchmark for many other types of debt. Collectively, this is known as the bond market. There are many other types of bonds with varying levels of risk and different features. They all exist because investors need or want to lend money, and various entities want or need to borrow money. Mortgage borrowers are one such entity. While lenders have enough of the same type of loan from mortgage borrowers with similar circumstances, those loans can be grouped together to form a bond that can then be sold to other investors. Once the mortgage lender sells those loans to other investors, they now have the cash flow to go make new loans, assuming there are no other investors who are interested in buying more loans, of course. Thus, a market for these mortgage-backed securities, MBSs, is born. It's quite a bit more complex in practice, but generally speaking, it's simply a market for groups of loans. These trade on the open market and tend to follow the broader movements of more mainstream bonds like U.S. Treasuries. That's why we follow the 10-year Treasury. Now, in short, all factors that can affect interest rates in the bond market can also affect the price that investors are willing to pay for those groups of mortgages. Those prices have a more direct influence on the rates than mortgage lenders can offer than anything else. Bottom line, loans become mortgage-backed securities which trade on the open market, and the prices of mortgage-backed securities dictate the rates that lenders can offer to new mortgage borrowers. Knowing the price that investors are willing to pay for a group of similar mortgages gives lenders a baseline for the costs they must charge borrowers. The lender's operational considerations will account for the rest. These considerations are all directly or indirectly related to how much profit the lender wants to make or how much business they are capable of doing. For instance, we tend to think of banks as always being available to make loans to borrowers who fit the right criteria. But that isn't always the case. Many mortgage lenders have a certain amount of cash flow that they ideally like to use over a certain time frame. If a lender isn't on pace to lend as much as they'd like, they might lower rates in order to entice more business. Now, conversely, if a lender is on the pace to lend out more money than it has, it could raise rates in order to slow that pace of business. Apart from the availability of funding, lenders must also consider the availability of personnel, or the capacity to handle the business. It takes a human to make loans happen, and at a certain point, a lender will be at capacity. It can either hire more staff or simply raise rates to throttle the amount of incoming business. We see that happen a lot with lenders, actually. These are two of the most basic operational considerations for lenders that complement the actual market-driven prices of mortgages. This can be thought of as a sort of business that sells a product made of raw materials. A car company, for example, is greatly affected by the cost of steel and aluminum, but the cost that buyers end up paying is also greatly affected by how that car company does business. How many factories do they have? How well trained are their employees? How efficient are they? In the mortgage world, mortgage-backed securities would be the same as the steel and aluminum, while individual lenders would be like auto manufacturers, each trying to sell cars as efficiently and as profitable as possible. The lender-specific considerations certainly change and certainly account for a portion of any given mortgage rate offering. Quite simply, this is why different lenders offer loans at different rates, even though they're all working with the same raw materials. But it's those raw materials, those mortgage-backed securities, that move throughout the day and do most to affect the moment-to-moment changes in the lender's rate sheets. If something in the world is happening to cause investor demand to increase in bond markets, MBS's mortgage-backed securities tend to benefit as well. When MBS prices rise, investors are willing to pay more for those bundles of loans, meaning that lenders may be able to offer lower rates. Now, conversely, if investors are seeking riskier investments for whatever reason, MBS's mortgage-backed security prices could fall, meaning investors aren't paying as much for mortgages, thus forcing lenders to raise the rates. So, I hope this helps you better understand what causes mortgage rates to change. If you'd like to know more, please reach out to me. I'd like to meet you for sure. And if you're looking, and thanks for watching, but if you're looking to purchase or refinance or need to refinance in the state of Arizona, I would certainly love to be your broker of choice. Until next time, take care and stay safe.